When you start a business, things are relatively simple. But as you grow, taking on more clients, inventory, and expenses, the financial weight of your operation starts to stack up. Eventually, the structure you started with struggles to hold that weight. Most people start out in the exact same default legal state, the sole proprietorship. In this setup, there is absolutely no legal distinction between you and your company. You are the business, and the business is you. Because there's no separation, you operate with full personal liability. If the business owes money, you owe that money directly. If a supplier demands payment or a lawsuit is filed, creditors don't stop at your business bank account. They can pursue your savings, they can take your car, and even seize your home, all to legally settle the outstanding debt. This creates a serious problem as you scale. Doubling your revenue usually means increasing your operational risk, which means your personal financial exposure grows right alongside your success. We need to figure out the exact moment you should upgrade your legal structure and deploy the Canadian Corporate Shield to protect yourself. Sticking with a sole proprietorship keeps your paperwork light in the early days, but you pay for that convenience by leaving your personal financial future entirely exposed. The alternative to carrying all that risk yourself is to officially incorporate your business. Incorporation creates a brand new legal person. Your company becomes an entirely distinct entity, separate from the people who own it. The difference is stark. While a sole proprietor carries full personal liability, a corporate shareholder operates under limited liability. Think of it as a barrier. It sits between the business operations and your private life, absorbing the impact of corporate debts. If a creditor comes knocking for an unpaid invoice, they must deal strictly with the corporation. Your personal assets remain safely on your side of that barrier, protected from those claims. Even in a worst-case scenario, where the business runs out of money and faces bankruptcy, creditors cannot breach that protection to seize your personal property. By making this transition, you sever the link between your personal financial survival and the day-to-day risks of running your business. To see how this legal barrier functions in the real world, let's look at a specific high-risk milestone for any growing business: signing a commercial lease. A 5-year commercial lease is a heavy financial commitment. You are legally promising to pay hundreds of thousands of dollars in rent, regardless of whether your business thrives or struggles. If you sign that lease strictly under your corporation's name, you maintain leverage. If the business fails in year 2, the corporation breaks the lease, and you can walk away without being held personally responsible for the remaining 3 years of rent. But this flowchart highlights a major vulnerability. That flexibility vanishes the moment you step onto the red path and provide a personal guarantee. Landlords know new corporations are risky, so they will often demand you co-sign the lease yourself. That signature is a personal guarantee. That guarantee creates a direct legal path from the landlord to your bank account. For that specific contract, the limited liability shield effectively disappears, exposing your personal assets to any unpaid rent. Protecting yourself requires operational discipline. You have to push back against landlords and creditors to ensure every contract stays exclusively in the company's name. A legal structure won't save you if you volunteer your own assets as collateral. The protection works only if you have the discipline to keep all liabilities strictly under the corporation. Beyond liability, a corporate structure opens up an entirely different set of tax planning options. As a sole proprietor, every dollar of profit is taxed directly as your personal income in the year it is earned. A corporation gives you control over when and how you pay yourself, whether through a salary, dividends, or a mix of both. To actually maximize these tax benefits, you need to be making enough profit to leave surplus capital sitting inside the corporation, where it gets taxed at a lower corporate rate. If the tax and liability benefits make sense for your situation, you have one more bureaucratic decision to make: choosing between federal or provincial incorporation. This comparison matrix highlights the primary distinction. Federal incorporation often carries a higher level of prestige and is the go-to option if you want your business to be immediately recognized nationwide. Companies planning to open offices or secure major contracts across multiple provinces generally prefer the federal route to streamline their national presence. As the final row appears, however, there is a common misconception that a provincial corporation limits where you can work. In reality, either type of corporation is legally permitted to engage in business anywhere in Canada, and even internationally. Choosing the federal path gives you a slight edge in national perception, but both jurisdictions provide the exact same foundational legal structure needed to separate your assets and scale the business. Ultimately, deciding when to incorporate is a calculation about risk isolation and how much leverage you need to operate safely. To map out your immediate next steps, we can use the scorecard. There are 3 key milestones: commercial leases, heavy debt, and cross-country expansion. Consider a solo consultant working from home. They carry almost zero overhead and rarely take on serious financial commitments. Without large contracts or significant debt, paying legal fees to maintain a corporation is an unnecessary drag. For this group, waiting is the strategic move. Contrast that with a retail owner opening a storefront or a manufacturer purchasing $500,000 in equipment. When your business signs major leases or takes on significant loans, your personal risk profile spikes. This is exactly when you must incorporate. As you transition, you must hold the line on your legal barrier by refusing to attach personal guarantees to contracts. Finally, if your roadmap includes aggressive nationwide expansion and you want the highest corporate recognition, that third box points straight to federal incorporation. Whether you file federally or provincially, the core rule remains the same. Once your business starts taking on real financial weight, stepping behind the corporate shield is the only reliable way to ensure a business failure doesn't wipe out your personal savings.